right, guys, we're live around the horn, part two. We got Samson, Jeremy here. I'm Bobby. How's it going, guys?
What's up? We're missing our fourth compadre, Brad, who I think is on his way to Colorado right now, right? Come to see us.
Yeah, saw him this morning. He's ready to go out and see you guys. So
Is that where the hot tub pick was at?
that was the epic hot tub pick up on the roof. Little morning sesh getting rolled out after a long week of working out.
Oh, that's what you're doing. Stretching and hot tubbing and drinking coffee.
That's about it.
Just a couple of grown men on a Thursday morning, just drinking coffee in a hot tub.
That sounds so uncomfortable.
I'm uncomfortable.
Steamy. It was steamy in there.
Oh man, well, what are we getting into today? What's the headline? What's the word? What's the word, fellas?
It's I guess I had a bunch of calls today with brokers in the multifamily space, specifically just to get an updated feel on the market as it stands. And basically, everything we were talking about on our last one, rising interest rates, decreases in leverage, all that stuff is starting to hit the market pretty materially. And a lot of deals where there would have been multiple offers at the table 2-3 months ago are crickets, radio silence, or maybe just one or two offers kind of trickling in. But it's always most interesting to get the broker's sentiment. And the one broker I'm thinking of specifically, who is a great broker, nobody's ever really experienced this type of market with future rent growth declining, recession on the horizon, decrease in leverage, increase in rates. And so everybody's still, I guess, optimistic. But I think it's going to get pretty painful for some of these over leveraged owner operators here in the next couple of months who are maybe forced up against the timeline that they need to sell. So I think that's maybe an interesting topic that we can kind of bounce around a little bit. Thus far, everything that the Fed has come out and said has been blatantly wrong. And so pretty much just do the exact opposite of what they said. But we know that it's pretty true that they're going to continually raise rates and probably raise rates again here next month. So Jeremy, what are you thinking on that topic?
You mentioned a line in there where future rents have been forecasted to decline. I was curious to maybe jump into that first. Where are you seeing that?
Yeah, well, just looking at like CoStar numbers and real page data and, looking at the forecasted rent growth. Most of these markets have been trending, 10%, 15%. Obviously, some of that's coming off of the back of COVID, but they're predicting a more normalized rent growth, which if you average it out across the last 20 years in most of these markets, it's probably going to be more in line with the average. And so I think if there's a recession, you have to account for the fact that everybody's purse strings are going to be pinched, right?
Yeah, so more of a normalized rent growth rather than the aggressive. Obviously, not to model a 10+%, but yeah. Right now it's probably more. It's prudent more than ever to keep that in line with historical, maybe even curtail it a bit more, depending on how fast that market shot up.
Yeah, I think you and I talk about this a lot, but a lot of these deals get done off of these, crazy rent growth projections. And we miss on a lot of deals because we're just not willing to model in a 8, 10, 12, 15% rent growth. But people are getting it. So I don't know. I just feel like at a certain point, it can't go on forever. I could be wrong, but.
Yeah, it's not sustainable. But I think one thing we've kind of kept an eye on is just an overall in the markets that we're buying and the median household income as it relates to a affordability component and percentage of their rent, and making sure that it's 3 times, 4 times monthly rent is what their income is. And as we kind of see that get closer to, you want your rent to be 20%, it's kind of like a sweet spot. 30%. You see in some markets, like where I'm in, at in San Diego or New York, it's like, or San Fran's like 40+% just because of the affordability imbalance.
Yep.
So I think that's fair. We're still seeing some decent wage growth, but it hasn't, like, as a percentage, hasn't, I think, paced with home price increases and rent increases, but it has been at least a little bit better than historically. Keeping up with inflation or not, TBD.
Yeah, and I think that's probably going to be a big limiting factor on most people. Like, it doesn't matter at a certain point, you know, how if your wage is increasing at a normal level, but gas all of a sudden hits $10 a barrel or $10 a gallon, and food and meat and all these other things that are basically things that you need to live everyday lives in the current modern society that we have. It's just going to make it increasingly challenging. So for every, percent increase in income, you got to factor in relative decrease in food costs and fuel costs to offset that.
Yeah, I'm curious, as the interest rates are continuing to creep up. I think it was not too long ago where the home ownership is now more expensive than renting, as, like, not including the down payment, just looking at it from a monthly payments perspective.
Yep.
So it could bode well with the lack of supply in several of the markets that we continue to focus on, and where the demand will continue to push towards rents, whether the rents will remain at that above average pace growth, or if they'll taper off as kind of everything pulls back a little bit. We'll see.
Yeah, to be determined.
One thing very interesting. This is where things start snowballing. California is sending inflation relief checks of up to $1,050 to people who qualify. Like more money, but there are less goods to buy. Like, you can't just print more money and, like, now there's all of a sudden more apples you can buy. There's only so many that can be produced and pushed around the world. So it's getting very competitive, and I think that's going to cause a lot of turmoil for people.
Yeah, well, you guys know I live here in this beautiful California state, and I was talking about this at dinner last night. It's like, we didn't learn from the first go around of printing and absorbing an amount of money, so why not try it again? It's good for, good publicity for politician headlines and such, but it's like trying to slap a band-aid when the Titanic ship is sinking. It's not even a short-term solution, because $1,050 or whatever they proposed is going to be
a third of your rent.
Yeah, like, where does that go, other than now that there's that much more money sloshing around? Like you said, you can't go buy more. They can't produce more apples. So interesting. I think it's a short-term, not even really a short-term solution.
It's a friggin' joke. Anybody who thinks that's going to save them is destined to get slaughtered in the recession ahead.
Yeah.
So I don't know. Their next move might be to try to limit rent growth by putting in some rent control. Their next growth might be price control, or their next move might be price control. So I hope they don't do that, because the more they just keep manipulating the free market, the more you just exacerbate the problem until there's inevitable cataclysmic event. You're just building the bubble bigger until it's so massive that the explosion is far more damaging than it would have been if you just let the market naturally correct. But that's me, the big laissez-faire guy that says small government and let the free market be the free market.
Yeah, one thing I've been reading also, or listening to, just trying to stay up to date on just, the markets in general, the amount of consumer credit, like credit cards, that have been utilized over the last couple of months to bridge these gaps. I think once people start getting to the point where they're comfortable with their lifestyle, it's hard to just kind of slam that on the brakes and say, I'm not going to go out to eat 3 times a week anymore. I'm going to just cut it back to once a week. They kind of become accustomed to, maybe going clothes shopping more frequently. And so that consumer mindset bridges that gap with different debt solutions by taking on more debt. And what's still accessible today are those credit cards. And I don't have the stats, I forget what they were, but they were a pretty alarming amount, how much they've jumped from when it was in March and April to now May and June, where we stand today at the end of
Well, that's even been, it's materially higher than it was in 2008 after the last housing correction, the last recession that we had. And that's because not only just the lifestyle, but we're a consumer economy, but there's also just the increase in the cost of stuff. You know what I mean? I mean, I'm paying an extra $20 at the gas pump every time I fill up, and I'm driving all over the place, right? Just in the state. So, and I drive a Yukon, right? So it's like $106, $110 every time I fill up. You do that once a week. That's an extra $400 or $500 a month. You know what I'm saying?
Yeah. Not going to tell you what we're paying out here in California then, because I pay more than that for my sedan.
Yeah.
Is it
Like,
almost 8 now? I know it's over 7.
I haven't paid 7 yet, but for premium, I paid $680 a couple times full, and that was because I searched and I found the cheap $680. So yeah, it's over. I've seen some places in LA just skip to 9. They're like, screw it, we're just gonna people will pay it. And it's funny because although gas is one of the only commodities you purchase that's a necessity, that's so big and bold, and they round up the tenth of a penny to not, and it's like, it really is price sensitive because it's right in your face every time. And although it's not, maybe it's a small percentage on the overall annual consumption and what's getting actually used, it is weekly. It hurts because it's just right there in your face, and you can feel the swings up and down from day to day, week to week.
Yeah, every day they're just advertising, this shit got more expensive today.
Yeah, and I haven't bought milk in many, many months, but every time I go and like I bought a half gallon this past week, and I'm just like, I thought I pulled out a half gallon, and I thought it was the full gallon price. I'm like, what is going on? And it's just absurd how daily commodities are through the roof.
Well, I read that book, the American Jubilee, and in the American Jubilee, they forecast how it's all going to play out. And this was written, 2015, I think, is when that book was written. And basically, step one is you bail out the big companies. When that doesn't work, you lower interest rates. When that doesn't work, you throw the money in at the bottom. When that doesn't work, then you start to cancel debt. And so there could be a very real chance that they go out there. And I mean, they're already trying to do it in the student loan world, right? But consumer credit would probably be the most meaningful debt cancellation, just given, how people are being forced to stretch and leverage credit and debt in order to, I guess, survive. That's probably using that term loosely. So, if they do end up doing something crazy like that, like a mass jubilee of credit, that's probably not good for the system. I mean, at a certain point, somebody has to get paid. Debt doesn't just disappear. You give me $50,000 and I agree to pay you back, and then the government intervenes and says, I don't have to pay you back. You're probably going to be pretty pissed about that,
Yeah, I heard a similar scenario a couple of years ago when they first started printing all the, the Great World Debt Jubilee settlement. And I know that obviously the American currency has been the world denomination for years, decades. And now that they're starting to settle like little things, I mean, not little, but like OPEC is now allowed to settle in the Chinese currency. And it's just trying to kind of take away some of that power of what the American dollar used to be. So I think I can see some of that start rippling in and cracking the system there a little bit. And then, like you said, the forgiveness of other debts, whether it's student loans, which is trillions of dollars, how credit cards unfold and get settled on an individual basis. It'll be interesting to see how that all unfolds. And I know that we had when I was, in the lending world, I would be more up to date on the forbearances that we had during the pandemic. I don't know how that's all kind of bundled up today, but I'm sure there's still 2 years later cans that have been kicked down the road and are still not getting settled. So I think we're still pretty relatively all-time lows with foreclosures. We have a different problem today where they're not variable rates, so they're not going to just hike up overnight because they're relatively fixed for the most part. But I'm just curious to see if everything else becomes more expensive and you have to still pay your mortgage, but your dollars now are covering all of your income your regular expenses. You start to slip, and now you can't refi and pull out cash because that time has passed. As the Fed's raising rates and values are getting crushed a little bit.
I heard some scuttlebutt the other day about some banks starting to push 7-year ARMs again, which are what got us into a lot of trouble in 2008. Because obviously, when the rates start to go up, there's all sorts of quote unquote new products that start coming out of the market because they need to keep the capital markets moving. They need to deploy cash. People want to refinance their homes, whatever it may be. So I'll have to dig into that more. I don't have all the details on it, but I can see that definitely exacerbating things in the future.
One thing that I think's interesting is how we measure productivity in America. Like our GDP is, we don't take into consideration how technology gives us a more efficient lifestyle and more efficient outcome. And, Zoom, like normally we might go to a meeting, spend some gas, put miles on our car. We need oil changes. We might fly somewhere. So that economic spending is not happening. So that makes our GDP appear lower on paper, but we're actually more efficient as a country. We're making better decisions. And I'm curious if our nation is going to change how we have that conversation, because if we're like, oh, our GDP is not growing, we're struggling. Well, it's like, maybe we're just measuring GDP in the wrong way. Like this needs to be considered, because even like your phone, it has a flashlight on it. So flashlight sales probably go down. It has a calculator on it, has a guitar tuner on it. Like all these things, they're converging into technology. So I think until we can have a good conversation just as a country and like reframe how GDP is measured, I think there's just going to be persistent issues even after this economic downturn, whenever it just ends.
Jeff Booth wrote a whole book on that, right? Price of Tomorrow, which is just all about how technology is deflationary in nature.
Yeah. I got to do a little kind of Twitter Spaces podcast with him like 3 weeks ago and talk through all this, which was super fun.
Yeah, that's pretty awesome. He's a really smart cat.
Yeah, so I think that's going to be really important. Like, when are we going to just be accountable for that? And just we were joking about Jerome Powell like beforehand about everything he's getting wrong. It's just like, when are we going to be honest and real about some of this stuff? Because people have been kind of waving the flag for years and they just ignore it and say, no, everything's good. It's temporary. It's this, it's that. Okay, it's permanent. Sorry, guys.
Yeah, I messed up. I think, it's funny. It's like they're so old school that they think that this information about the things that they say isn't just continually floating around the internet, and they're like not getting turned into memes because of the dumb stuff that they said. And the exact opposite has come to fruition. Any freaking idiot with half a brain could have told you that math doesn't add up long term, but I guess eventually, when you're a pathological liar, like you start to believe your own bullshit. So, I don't know. The positives, I think that a lot of what's going to happen is, you probably have heard me talk about this, like do the hard stuff, and the blue collar jobs and the people who like to get out there and actually hustle and work, those people are going to thrive in the next phase of our economy as the baby boomers kind of pass on their businesses and exit, and a lot of manufacturing and production and whatnot comes back to the United States, simply as a byproduct of the fact that the rest of the world won't want to play nice with the United States, and we don't really have to. We're going back to deglobalization and to economy more similar to what it was like, pre-World War II. So I think
Yeah.
that'll be the thing that probably saves us, but that doesn't mean it won't be a roller coaster for the next, 7 years.
For sure. What else is going on in the world, man? I saw, this is kind of off topic, but I saw Joe Biden say today that drunk driving should not be a felony. And I was just like, okay, everything's getting a little wild.
We've officially lost our minds as a country. It shouldn't be a felony.
I think, yeah, like the deleveraging though, bringing it back to what you were saying earlier, a lot of that's even happening in the lending space in crypto, like the CeFi world, like Celsius, BlockFi, Three Arrows Capital. All of these people rehypothecating so much, all of these guys collapse. They're like bankrupt, and I think there's obviously a ton of that going on in the legacy system, but we're gonna have to have a nice reset. I don't know if it's like the great reset, like the whole debt clearing. I know there's like 3 or 4 ways it could be handled, but I think there's just so much leverage out there and just all of these different things. That's what gets me excited about multifamily. Like my money in multifamily is just doing great. My money in stocks, like in the retirement account, my Bitcoin, obviously, like everything's down now in the short term. And multifamily is just, you get those sweet little checks coming in. It's like the only thing that's like certain right now. It just is it always feels good in these times.
Yeah, I mean, I think buying cash flow assets is key, right? So we talked about this a little bit on the last one of these, but businesses that cash flow are going to become more attractive to people and more attractive to capital allocators who are experiencing some pretty heavy pain right now. So cash flow pays the bills, man.
Sure.
Well, it feels like this was a semi underwhelming around the horn, but it's pretty much the same talk track that we've had, which is rates are going up, leverage is going down, everything's getting repriced, and we just kind of take it as we go.
I saw, I think it was Grant Cardone call out either April or May, pretty specific timeline as to when he thinks some commercial real estate value will really start to see a steep discount, which is 10 months away. Curious to hear what you think on that in terms of timing, or if we're already there in terms of those discounts. And there weren't any specific numbers other than a timeline.
Yeah, I mean, based off of my conversations that I've been having with brokers, they're advising their clients if you can hold to hold, but there's still sellers at the table who want to sell. And so, I'm always concerned when there's over optimism in the market, oh, but this time it's different. You know what I mean? So we've been very blessed in the last 12, 15 years, coming out of the recession to not really experience this. But with a lot of culminating factors coming together, right? Lower leverage, increase in rates, equals, forecasted recession coming, inflation hitting, lower wage growth, more expensive consumer goods. And that's a recipe for a recession. So it just can't keep growing like it has. And so, I think it's only going to get worse before it gets better. It might be 2 years before the whole thing rounds out. But I think like 2020, all the brokers were like, oh man, here it is. It's going to fall apart. And then it paused for like 2 or 3 months. And then things screamed like all-time highs, right? So they might be predicting that that's going to happen again. But who knows, man? I have no idea. We haven't seen a healthy correction. I know that. And I know historically speaking, the market corrects every 8 to 10 years. We're well beyond that now. So it has to. It just hasn't done it yet.
Yeah, it was like a little blip 2 years ago.
I got a question for you, Jeremy.
Shoot. Let me get my Google open. Hold
Well, so here's the thing, right? So there's always the talk track in around multifamily, right? Is it's had more up years and less down years than the stock market. It cash flows during the Great Recession of 2008. The default rate on commercial multifamily was less than like 1%. But I don't feel like bridge debt was as prolific in multifamily as it has been in, say, the last 3 to 5 years. Not as like aggressive. I feel like it was a lot more common to put on like longer term non-recourse debt, like fixed rate stuff. But being a bridge lender, what are your thoughts, or am I just making that up?
I don't have any stats on that, but if I had to guess, my assumption would be that 2006 or 7 and prior to then, there was likely less competition in this space and therefore higher cap rates and therefore likely easier to place permanent financing, Freddie Fannie agency loans on these acquisitions that didn't cause as much of this necessity today where you're buying really your two pro forma basis that just isn't a good fit for Freddie and Fannie. I know that when I think it was 08 when the Jobs Act was passed and essentially opened up this 50 Reg D 506 arena to allow syndicated or crowdfunding types of platforms, which made it more competitive, more accessible to the everyday person, accredited or not accredited, which was a nice thing, but it just bred more competition. So I think tons more capital just flooded into this space as well. So those are kind of the two things that come to mind first off, but I'd be curious to see what the percentage was of fixed or more permanent and bridge 15 years ago versus what it is today. Because I talk to my agency lenders every week, and they're doing mainly just refis right now, definitely not acquisitions. And we're starting to see that maybe shift a little bit.
Yeah, that's interesting.
My 2 cents.
Yeah, other signs that I'm seeing are I spoke with some excavators and contractors, and they started getting their first contract buyouts where people are saying, hey, we're pausing. We just want to buy out our contract. So more projects are going on pause, which is probably a sign of the times as well. So
in terms of like ground up development, folks?
Yeah, ground up development projects. Yep.
Do you think I feel like if you're building ground up right now, your costs have already been baked in. I think lumber is starting to come down a good bit, and labor's got to start also becoming a little bit easier to attract. So I would think the way to finish a project is not going to get more expensive. It's if you're locked into like a GMAX contract or GMP, you should be able to finish.
Yeah, maybe. I mean, some of these projects have dragged out for so long, and I don't think the talent recruitment's getting better. I mean, I know a couple of very big contractors here in the state of Colorado who, several, call them $50 million plus developments, and they're not even sure they can take the contract because they can't get enough people to actually run the project. And they're still seeing material price increases at 1% per month. So that's on top of the 30% increase that we saw last year. So, I mean, I don't know. I mean, you and I priced a multifamily development. It was $230,000 hard cost per unit. That doesn't account for any of the soft costs, which is probably like $30,000 to $40,000 a unit. So you're, $280,000 to $300,000 a unit. But we underwrote it. You don't see the rent. The rent's not there. The rent growth is not there. So how do you make that deal make sense? I don't know. I mean, you got to have some, I guess, giant watermelon size cojones to say, I believe in this market and the path of growth and where it's going to go, to pull the trigger on that one.
You got to go knock on HUD's door, get them to max out, and just say, hey, we might not be at that 1.2, DSCR today, but I think by the time you go and finish your process, maybe rents increased a little bit. You got to get some long-term money on that, or obviously sell.
Yep.
But you don't know the environment you're selling into, and that's the risk. If you were able to sell before maybe March of this year at the peak, the last 2 years, you did all right. Catching the upward wave.
It's a super attractive lending product is the SBA 504 loan. You know what that is?
Not as familiar with SBAs.
If you own a business, you can get this loan. It's a 25-year fully amortized loan. It's 50% first from the credit union, and the second 50% is from the SBA. Your blended rate right now is like sub 5, and you only need to put 10 to 15% down. And if you have a business, you can buy your own building. You can even buy it on pro forma. Crazy enough. If you've been around for 5 years, it's a little bit easier to get the funding for it. If you're sub 5 years, 15%. But actually, the gym that I own, I'm going to flip some cash into buying that building because it's actually cheaper to own the building than long term. Plus, you get all the depreciation leveraging the 504 loan than it is to actually continually rent. So
are we going to open up our next business?
Yeah, I mean, well, there's a strategy there, right? Like you find a good cash flow producing business who doesn't own a ton of real estate, and you go buy some real estate, put it underneath that sucker, and you're in the game.
I started following a ton of small business Twitter accounts that talk about how you can take say you have 150K, you can acquire a small business that's right around $1.5 million. And there's just a playbook you can follow, and the returns are like 50-60% a year, and you can sell the business in like 4 to 5 years. And it just seems if you're a good operator and you know how to lead people, that's just such a good playbook to not only pay yourself, but then sell the asset and make some money. So I love the idea of that. And I think it is going to be really popular with, how many baby boomers are retiring. So I think that's going to be a great opportunity for people this next decade.
Yep. All right. I think I'm maxed out for the week. Any final words of wisdom? Oh, by the ways, I forgot, as Brad would say.
Yeah. No, stay tuned. We're going to do another one here in a few weeks. We'll get the schedule locked in, and we'll make it clear and share with everybody.
We need some tickers here going across the street. Feds have increased SOFR in the 10 and third, I like your block behind you, Bobby. And then also for 30-year mortgages, 10 years, agencies, maybe we'll get that as a banner.
Yeah, let's do it.
They're on a box.
Be
right, everyone.
We'll turn it into something a little bit more production quality. But right now we'll just stick to the crappy Zoom call. All right, guys.
We appreciate everyone watching. See y'all next time.
Peace.